Hi guys, Christina Blue here with Keller Williams Beach Cities. Today I want to talk to you guys about contingencies. What are they? So contingencies give parties the right to back out of a contract. These contingencies are listed on the RPA, which is the Residential Purchase Agreement. That is the legally binding contract between buyer and seller to purchase real estate. So contingencies come in all shapes and sizes. It really depends on what your needs are. But a standard contract has 3 contingencies. The first one is a loan contingency, and the standard days of that is 21 days for a loan contingency. So what that means is you've likely, saw a house, you like it, you write a purchase agreement, and you have a pre-approval, which is from the bank saying, I think we may be able to give you X amount. So it's not an actual loan. So you want to make sure that your offer is subject to getting an actual loan. So that's the first contingency. The second one is appraisal contingency, and that is a standard 17 days. So that gives you enough time to get an appraiser to come out, value the property, and you want to make sure you're purchasing a property at the actual market value. So that again, if it doesn't appraise at that rate, then that's your choice to either pay extra or back out based on that contingency. The last contingency is a buyer's inspection contingency. That is typically about 17 days, and that gives buyers enough time to do their due diligence, do their inspections. Maybe there's a chimney and they want to get that inspected, or a roof. That gives them the time to look over all the disclosures and make an educated decision on whether they want to purchase the home or not. So let's say you have exhausted all of your contingencies, you remove them, you're ready to go, you're skating through escrow, and you lose your job, or you just decide you don't want to buy the house. So you still actually have a way out, and all of your contingencies are removed, but it doesn't mean you have to purchase the home. What that means is that you will lose your deposit, your security deposit most likely. So the seller has legal right to your security deposit, which is typically 3% of the sales price that you put into escrow within the first 3 days. That's called your earnest money deposit. So that's really what's at stake. If you remove all your contingencies and you don't want to purchase a house after that, then the sellers have legal right to claim that. So that is contingencies. Just a little recap. That is that contingencies give the right to parties to back out of a contract. And the 3 main ones are loan contingency, appraisal contingency, and buyer's inspection contingency. Great, I hope you guys have a great weekend. If you have any questions, message me. Bye guys.